Thank you. Since we're going to pitch newsletters, I thought I'd pitch our daily trade newsletter at Bloomberg, Terms of Trade. I'm very happy to help you sign up for it later. It is, of course, much, much more prescient than anything you'll get on Axios. But I do subscribe to Axios every day. But thank you so much. I'm really excited. I spend my days covering the world of trade and globalization. I've spent a lot of time on the U.S.-China trade wars lately. But as I think some of the people on this panel know, for a number of years now, I've been quietly obsessed with the world of digital trade and digital globalization. And part of that is because I'm the father of a teenage son and a soon-to-be teenage daughter, and it has helped me understand the world and think a little bit differently about the world. Earlier this year, I wrote a piece in which I think both Susan and Richard featured for Business Week on how if you want to understand the global economy today, you should really just go hang out with your teenage son or daughter and play a game of Fortnite. And there's a reason for that, because in Fortnite is just about everything you need to understand the global economy today. And that ranges from data flows. I didn't know until my son told me that you could, for example, leverage data flows to take on easier players on Fortnite by switching your geolocation on your Xbox or computer. That apparently is something most teenage boys will tell you they can do. And so my son liked to take on easier marks on Fortnite in Brazil, for example, and would do that. But he was also, while he was doing that, he was also spending my hard-earned money via digital transactions that were kind of pinging around the world. He was learning how to do all of this by watching YouTube videos featuring a YouTuber sitting in suburban London who was trying to figure out how to get into the Chinese Fortnite servers to try and figure out if there were any easy marks there. And all of this was done on a platform that, at the time I wrote this article, had 200 million registered players, the size of a country like Indonesia. And by March of this year, just a few months later, had 250 million, had added 25% more players. And by this time, I'm sure is up to 300 million or so. And earlier this week, literally became a black hole when it went down for a couple of days, upsetting teenage boys around the world. Became a major cultural event that was written up in the press and so on. If you want to, and all of this is also a phenomenon that has been fueled and is there for us because of Chinese capital. Tencent owns 40% of Epic Games, the North Carolina company that created Fortnite. And as a result of that Chinese capital, they've created a whole new games model whereby you can play this for free, and it's all about micro payments. I invite you to read the article. I also did a podcast as part of our Stephanomics podcast series about this earlier this year. I still think that holds pretty true, and that's part of the reason I'm really excited about the discussion we're going to have here today. We're going to keep it fast and loose. I've got an iPad here that to which you can flip your questions. If you prefer not to do that, you can just raise your hand later on. We'll get interactive. But we're going to start off with just a few minutes up here on stage. And Susan, I want to start with you, because you, a few years ago, did a report that became the basis for a lot of my thinking about this on digital globalization. And you've continued to do a lot of work at McKinsey on kind of tracking this change in patterns in globalization. So when we look out at the world today and we think about globalization, how should we be thinking about it? What should we be taking note of? Why don't we start there?
How should we think about it? Well, I'm going to start with the obvious, the thing that you all know, which is trading goods is growing much more slowly than it used to. And this is even before the US-China trade war that's displaced the bilateral trade flows and spread it out to other countries. We had a period, and most of us think of globalization as being about trading goods. It was the creation of these long global value chains in Asia, and it was a period in which trading goods grew twice as fast as the world economy for a good 20-year period. And many companies, especially port operators and logistics companies, started to think of this as like the new normal. Trade is always going to expand twice as fast as global growth. Well, for the last 10 years, that hasn't been true. The Great Recession disrupted things. But even after we sort of recovered from the Great Recession, what we see is that the world is less trade intensive. More of what's produced is now consumed in the country that it's produced rather than traded across borders. Now, does this mean globalization is over? No, absolutely not, for 3 reasons. One is that trade in services, which isn't discussed or focused on, continues to grow. And particular types of trade in services like telecom, travel, intellectual property charges are growing 2 to 3 times as fast as global goods trade. So there are parts of the services trade that are digitally delivered that are growing very fast. Secondly, we don't measure services trade very well at all. We don't look at the value that services create in manufactured goods. So when you think about goods producing companies today, a lot of the value comes from either the upstream design, innovation, R&D that goes into the product, or the downstream distribution, sales, and marketing. So Apple is a perfect example. They actually don't manufacture anything, although we think of them as making our MacBooks and our iPhones. They control the valuable bits, the upstream design, and then the downstream marketing and selling of the products. And they completely outsource the middle. So when we talk about manufacturing trade, actually there's a lot of services embedded in it. So services are more important than we think. And then finally, I'll just point out, the Fortnite example is a great one. No matter what happens to trade, if we never traded another good or service across borders, we still live in an incredibly globalized world. And that's because of cross-border data flows. And it takes the form of kids playing games with people in other countries. In the business world where I work, we see it all the time. It's HR files flowing from the US or Europe to India. It's my car is pinging data bits from my Volvo here to performance in Sweden. It is all manner of different types of corporate information sharing, communication. Some of it is on the personal side. But all of this creates enormous value. And when we really think about what was globalization about, it's about the flow of information and the competitive pressure that creates. As an economist, I think that raises productivity, but companies today are completely exposed to what competitors are around the world are doing just through the flow of information, whether or not they're actually competing head-to-head in a particular market.
Yeah. Richard, you've got a book in your lap that's just one of a couple of books you've written on this subject and so on. But this one's this is the scary book, I think, of the globotics upheaval. This is all not such a wonderful thing, and that all of us white-collar workers should be braced for the same kind of disruption that blue-collar workers have had from globalization over the past 20 or 30 years. Walk me through all the reasons I should be afraid.
Absolutely. 2 minutes for a 200.
Yeah, sure, that's fine. Yeah, we can do that.
I'll talk very fast.
He's signing copies after.
So, I agree very much with what Susan, and I love the January report, MGI, sort of documenting how important services and intangibles are. I think it's up to about half of all world trade flows are not really what we normally think of as trade. So I agree totally with that. The thing I would like to sort of characterize it is globalization is arbitrage. When prices are different, people buy where it's cheap and sell where it's expensive. And when it comes to services, the professional service sector workers in the rich countries are overpriced by international standards, and those in emerging markets are underpriced by international standards. So as digital technology makes remote people less remote, you start to get that arbitrage, and that's trade and services. People sitting in one country working in offices in another. So that, I think, that's the scary thing. A lot of people who do not know about globalization are going to find out about it directly. But just to put a little parenthetical statement on this, I like Professor Gimawatt's cage notion of distance, cultural, administrative, geographical and economic distances. And digital technology is really just bringing down the geographic one, but also maybe a little bit cultural with machine translation. So we are not going to a flat world, but since the price differences are so large, all we need is a little bit flatter and we'll get a lot more trade. So the other parenthetical statement on this is that this is a win for the emerging markets and more competition for the rich markets. So basically, the people whose wages are underpriced by international standards, this is an export opportunity. For those who are overpriced by international standards, it's more competition. So, and then just to my last sort of major point, and you alluded to it, is the same technology is leading to automation of the same jobs or similar jobs at the same time. So as the service sector in the rich countries is being exposed to more globalization, it's also being exposed to more automation with things like robotic process automation, virtual assistants, artificial platforms. So that's what puts the upheaval. Did I mention my book?
Oh, I don't think so, Richard.
Okay, so upheaval, that's what puts the upheaval in the second word of my title. I'll stop right there.
Yeah. Carol, you've been working for a long time on this intangible world, right, of economics. Explain to us a little bit, when you look out at the world, what is that intangible world that you're talking about? What's this intangible capital that's in the title here?
Okay, well, thank you. That's a great way to sort of just maybe get a little bit more away from the global and just sort of think of the firm and the aggregation of firms within an economy. So what is intangible capital from the point of view of the firm? Well, a financial accountant would call it an asset that is not physical, which is not a very economic definition. But basically, when we think of investment as economists, we think of it as spending that's going to yield a return in the future. And by that metric, much of what firms spend on high-level marketing strategy, much of what they spend to reorganize their business model, and clearly what they spend on R&D and the development of designs, attributed designs, anything that would be patented, all of those activities end up being called in the bucket of intangible capital. Did I mention digital software tools? I did not. Those are probably the biggest thing these days. Now, what does this mean? Well, one thing it means is that there has been this massive shift towards intangible investment among firms in the United States. So let's just talk about businesses. In fact, intangible investment exceeded tangible investment in the United States in the mid-90s. Now, Europe and China and Japan are pretty far behind us on this metric, but they're catching up. The UK is very close to where we are, or they were. So that's why it's important. It's just one of the major things that firms do to establish a competitive advantage today in the world. So I've done a lot of work on what this means sort of as a descriptive macro point, also a lot of work of what it means for productivity and growth and what are the drivers of growth, because it changes the way we think about that. And also some recent work that sort of shows that this productivity dispersion that the OECD and I believe MGI has also done some work on can partially be explained by intangible assets, without getting into the details. And so although our state of knowledge is not perfect on these matters, I think where it's really lacking and what may be of most interest to this audience is the following. Anything having to do with what it means for finance, global finance or domestic finance. Number one, what does it mean for the business of banking? How does it change the way loans should operate? Does it change the way we think about how we should finance startups or entrepreneurship. We don't think about that in the United States because we have such well-developed venture markets. But that's not true elsewhere. And regulatory actions could incentivize the financing of small businesses elsewhere. And third, I think it has an implication for what we mean by infrastructure. A lot of people have written on this, and the concept of digital infrastructure is, I think, pretty understandable. But we don't deal with physical infrastructure very well, certainly not in this country. And we are ignoring, possible investments elsewhere in the world from the point of view of international institutions anyway, it's important elsewhere. I don't want to go into the details, but you can see that, any aspect, banking, what small business, large infrastructure projects. The fact that intangibles are really driving the competitive landscape needs to be factored into.
And we're still struggling to measure those intangibles, which is maybe something we can come back to later. In terms of worlds we're struggling to measure, Christine, the world of services. Susan made a reference to this as well. I still feels, I look at services trade in the world, and I just kind of discount it a little bit. It feels like it's a lot of tourism and not much else that shows up in the data, and yet I know there's so much more, right? That video conference I do with a colleague doesn't, in a far-off land, doesn't show up in global trade, and yet clearly there's some kind of value in what I'm saying, and it's going across the airwaves, hopefully. But Christine, this explosion of services now and how we should think about it going forward, just walk us through that.
Well, thanks very much, and thanks for the opportunity to be here and part of this very distinguished panel. So let me start by saying, and this won't surprise all of you, so we're a service economy, and increasingly a services and digitally enabled economy. 8 out of 10 of us are in services jobs. In fact, everybody in the audience is probably in a services job, and everybody sitting up here is in a services job. 80% of our GDP. And that pattern is very, very similar, certainly throughout developed economies and increasingly in developing economies. What does this really mean? And I might take exception to say that there's an explosion in the services economy. Actually, the services economy, as Susan Lund was saying, services trade and investment has been a major feature of the global economy for a very long time. And basically, services underlie most, if not all, of economic activity, whether you look at manufacturing, whether you look at agriculture, energy, across the board. But where the explosion comes in is the digital piece, and that happening in the early 90s, in particular with the advent of the internet. And what you have there is really a marriage between service activity and digital activity. And what's the connection? And that is data flows. Because the kinds of activities that historically might have just been supplied in person, some of those, but not all, can be digitally delivered on a cross-border basis as well as in country. So I think it does all lead back to the explosion in data flows, which there is clearly an explosion, and the advent of the internet and how it's transformed the services sector itself, but every other sector in the globe. Couple of other things that's not well understood, and that is before this explosion in the digital economy, the main way in which services were traded is by investment, not cross-border. And that continues to be the case today, that the lion's share of the services that are supplied globally is via investment. And why does that tie back in interesting ways to what's been introduced? And that is that the transfer of technology that Richard talks about in his books and that you're talking about in terms of intangibles, a lot of that trade has already been occurring. If you look at services statistics, you look at licenses and royalties making up a huge percentage of cross-border trade flows. And so what that means is often between parents and their foreign affiliates, you see licensing arrangements of that technology going back and forth. So yes, it's a huge part of the picture, a huge part of the investment picture, but I just wanted to point that out in terms of measurement. That's one way you can look at it. I also just very quickly wanted to say that in terms of arbitrage, I would argue that arbitrage, a lot of that's going on as much domestically as internationally because there are limits in areas like professional services to how much those cross-border services can be supplied because of licensing and other requirements and what you can do. Back office processing is already very much and has been a feature of the global economy. So just to point that out. And the last point I will make, because it's so rich and all of you have written such great studies on this area, but in terms of intangibles and understanding what that means, in the United States in particular, national security concerns are a huge factor. And what's happened in the United States with FIRMA and the reforms that have been made in CFIUS and the tightening in that regard, a lot of that is directly aimed at the kinds of technology that's being acquired by foreign firms. So let me stop there.
Yeah, and maybe we can talk about deemed exports and so on later on. Sherry, you and I are both in the data business. We work for competing companies, but that's why we're at the other end of the stage from each other. But you, like us, look out at the world, and you also see some kind of barriers popping up to some of this new data flows. You know, there is an adage in trade: if an industry finds a way to protect itself from international competition, it will employ that way. And there's really no difference in the world of data or tech in some ways. When I look out at China, I've often thought of the Great Firewall of China as one of the great protectionist tools in the world today. But talk me through this new world and these new trade barriers that are popping up.
Yeah, I think we're definitely on a journey here, and I'm interested in that first word, which is data. And you suggested perhaps you won't take the word exploding, but I will. I'll take that word. You know, data is certainly exploding in terms of size, volume, as well as sort of types of data that are being demanded. And of course, we have a particular focus on the financial services industry and how we feed data into that to make good decisions, et cetera. But this balance is becoming much more apparent between globalization and localization. And this concept of a barrier, frankly, if you're looking at data, it's very prevalent. You mentioned China, India as well, a big concern as to where they're pushing for their data localization laws. Thinking also about Indonesia. These are countries that have got high growth rates, enormous amounts of data that are indigenous, and arguably a non-tariff barrier that they're putting up in terms of creating an indigenous use of that data that is not potentially going to be helpful in promoting a cross-border environment that continues to promote trade. And so why do we care about this? If you're talking about data crossing borders and having perhaps borrowing from the G20 nomenclature of data free flow with trust, if we're going for that, there are three areas I want people to think about in terms of certainly what we think about that are problems if you do create these data islands and data barriers because of localization. The first one, and one that's really important for us to think through well, is fighting financial crime. So the statistics say that 2 to 3% of the world's GDP is actually in the form of illicit financial flows. In Europe, guess how much is actually captured? 1% in Europe. So there's a huge amount of illicit financial flows that are coming out of financial crime that have no barriers. These are not things that a criminal would start thinking about, oh, well, I better keep this within the country because there are data barriers to this. Not at all. And in fact, if you look at banks, you look at financial institutions, the requirements coming down the pipe on anti-money laundering, on know your client, if you pair that with these data localization barriers, and actually some of the barriers that are coming out with some of the new privacy laws, it becomes a real problem. We're creating two different push-pull points there that are actually not adding to the benefit and creating potential safe havens for criminal activity. And that, I think, is one of the things that we need to really make sure that we get right. I said there were three. The second one is thinking about sort of how do we meet some of these climate change challenges. We talk a lot about sustainability, thinking about data. There's certainly not enough data. There's a drive towards disclosure. We're one of the biggest providers of ESG data and disclosure data, but actually, when that starts getting limited in terms of where you can share it, the detail in terms of who is involved in some of these projects, what is the implications of those that are being involved in particularly infrastructure projects around the world that are perhaps destroying environment, those that are sort of promoting sort of poor disclosure requirements in not only geographically but in different sectors. This is a problem for everyone. And the third one is thinking about de-risking trade. Because if you're looking at sort of who it is you're working with, and if we hope that we can still say that we're in a very global world in terms of doing business, then we need to be able to share information about who it is that we're doing business with. And being able to follow the money, but also follow the characters and the primary principles involved, and understanding sort of how that data can be passed through, so you can make a real decision as to who you want to partner with and how you want to do business. So essentially, these are three examples, but the real risk we're talking about here is fragmentation. We talk about it in a lot of different places on the financial system, but actually fragmentation in this area about having data islands, really causes an increase in costs, particularly in the financial system, as well as increase in risks. So a couple of things to think about in terms of sort of how this manifests itself is that actually we're not just talking about sort of specific pools of data. We talk about personal data, we talk about business data. For us, we talk a lot about financial data. But what are all these things actually? How can you put a circle around them? What is a piece of data that's meaningful and material? It entirely depends on actually what the purpose of that data is. And so in being able to try and create an understanding of a pot of data that can or can't be moved across a border actually runs into problems immediately. And trying to understand sort of at the global level how it is that we can create a common understanding of how that trust factor of sharing data is predominant to our future, the sooner that gets cracked, the better. It's complicated, but I think that there is a real need to focus on this and make sure we get it right. And I guess, in terms of sort of thinking about sort of the challenges, as well as the great opportunities that this data proliferation offers to us, I think, in the financial markets, we need to start considering what we mean by data. We're getting huge amounts of demand for alternative data. This is not just stock data or bond data or something that you would instinctively think about as being a market-moving piece of data. And so if that's the case, then actually having these enormous data lakes and being able to actually pull that information into a system to make a decision starts challenging the entire financial system in terms of disclosures, in terms of earnings reports. Where is sort of the barrier of some of that? How is it that someone who's sitting in rural Idaho, as an example, can actually adjudicate a stock that's on the Shanghai Stock Exchange in a way that actually has as much transparency as possible? In order to sort of move towards that sort of thinking about more and more transparency, we do need to be able to facilitate a flow that gives more sources of data the ability to get to those that are trying to make good decisions. So some big picture thinking there, but I do think that the barriers and need to be talked about so that we can actually really innovate and make the most of the fact that we have this data explosion.
So let's pick up on something you raised there, which is this word fragmentation, right? And if I think about the U.S.-China trade wars today, I'm thinking about them as technology wars as well. Hank Paulson has talked about the new economic iron curtain or technological iron curtain descending on the world, where we get tech supply chains fragmented into a China-based and focused one, and a U.S.-based one, and possibly a European-based one, and so on. But when I think about the world of data and digital globalization, it isn't just about data for analytical purposes, but it's also about data that's tied to a product that's going to a 3D printer. Rolls-Royce for years now has been manufacturing fuel nozzles on 3D printers in remote locations. And how do you do that? Well, you send an email instruction across the
the world, and that doesn't get captured in the trade flows. Therefore, it shows up as almost a slowing of globalization, but it's this kind of whole new world of globalization. If we fragment all that, and you get kind of one stream of digital fuel nozzles going, to China, another going in kind of the U.S. supply chain. Susan, how does that fit in with the world that you're seeing? Because you're already at McKinsey starting to talk about the regionalization of the world rather than globalization.
Yeah, look, I think there is a real risk that we have divergent technology standards, particularly around 5G. And I think a lot of folks who know more about technology than I do are playing out what does that future look like. I don't think it's necessarily baked in the cards yet, but there are real worries about, and we've already seen it, frankly, because of the Great Firewall of China that you've talked about. This is why China has its own set of Google, Amazon, et cetera. And because they've got 1 billion people in their market, they can actually do that. Now, how that plays out to other countries and which standards they end up adopting, I think will be the big question mark. As to your question, could it mean that, for instance, we can't, send data around the way we do on the internet? I mean, I don't think it's come to that yet. I mean, we've got the undersea cables, and that's why over the last 10 years we've had this explosion of data, right? It's the build out of the physical infrastructure that's done it. And regardless of what happens with 5G technology coming from China, or it's actually Ericsson, then we'll see. I don't see the interoperability point is different than who builds the hardware, and I think it's incredibly important that we think about maintaining that interoperability regardless of what the underlying
Christine?
technology is.
Well, first of all, absolutely agree with the word explosion with respect to data. My point was more just services itself being a big part of the global economy. But with respect to your comments and to Susan's as well, it certainly doesn't go the whole way to solve the problem. But I think bringing in the trade piece is relevant because certainly in trade agreements, the U.S., really beginning with TPP, but then with USMCA and most recently with US-Japan, and the digital provisions that have been included do try and take on both the cross-border piece because there are unfortunately barriers to cross-border data flows that are being encountered. Certainly financial institutions are unfortunately a prime example of that, even for a bank to process in the ordinary course of business information and get it in and out of the country. That's run into problems in certain countries. But data localization, a huge problem. And there are now disciplines that have been extended not only to non-financial services, but financial services to try and address that. The problem is those disciplines don't apply to India or Indonesia or Tanzania or other places. Those requirements are cropping up, but just wanted to interject that it doesn't go the whole way. But I think it at least is a start, and trade rules, I think, are one way of getting at that. And finally, you mentioned fragmentation. Certainly in the insurance and banking sectors, I'm aware that that topic is very much under discussion now. And the Financial Stability Board, I think, has picked up on that too. So this link between data localization and fragmentation is very important.
Carol?
So many good thoughts from everyone here. So let me just sort of say like 3 things. Number one, when it comes to data, certainly our experience with this is, primarily comes from the financial world. We're grappling with it when it comes to personal data and how that should be, how we should deal with firms who don't protect it. But there's a whole other realm of data that we don't think of, but will become very important strategically in the future. Well, it really is now, but it's not something you hear commonly talked about. And that's biodata. In other words, just data on the human genome, much of which is public, but what your genome is and what your genome is,
right,
and what your DNA is, that isn't, or at least it shouldn't be, right? And let's sort of Well, here's the rub, and this is China. I mean, I can see how we can coexist with two different standards for 5G, no problem. I can see how they can have their digital world and we have our digital world, no problem. However, they are facing a demographic challenge. They are facing high rates of cancer and other diseases of the industrial world. And it's a major strategic battle for the solutions to certain problems that would benefit all of society. And all these things are patentable and can be a subject of concern. The National Academy is going to come out with a whole study on how to protect the bioeconomy, by which they mean the risks that we face sort of strategically and defensively about how we keep our the information on our population private.
And we've already seen that crop up in terms of cross-border investment decisions. CFIUS blocking in, for example, Chinese buying Tinder, for fear of the data there. Look, I hopped on a plane the other day and I showed up the gate wielding my boarding pass and I said, you don't need that, just look into this camera here and we'll let you on. It was the first time that it happened to me in the United States. And then I got off in the UK and I was able to use one of their digital gates, which of course allows me to get in again on the back of facial recognition data into the UK. I never talked to a human until I got back to Dulles and I got to wait in the passport line for an hour. But there. Richard, Richard and Susan perhaps, and Carol maybe jump in. We're running out of time here very quickly. But we got a good question here, which is someone clearly is incredibly knowledgeable in the audience here points out that the 1988 trade bill required for the first time the inclusion of services trade in the overall trade balance, not just merchandise trade. Okay, so we've had a digital revolution, but really what's what you guys are talking about different? Give me something tangible to explain what the difference is. And I guess this gets into also that measurement question, Christine and Susan. Right, Christine or Richard, do you want to take that first?
Sure. Well, so let me just say that it's very different what crosses borders.
Yeah.
So that's the whole thing. In some ways, you can think about trade in goods as being made somewhere because the labor there is cheap. Then they put the labor into the good, and then the good crosses the border. And with the services, it's crossing without the good going across. Now, that makes it very hard to measure, very hard to tax, relatively difficult to regulate. So it's different in many, many different ways. But if I can just also spin it out a little bit different and to throw in with the data thing is, this whole discussion about data, I think, needs a lot more nuance. And it reminds me of the services discussion in 1988, before we got the modes. People would be talking about services meaning entirely different things, and the modes aren't perfect, but I think we need some baskets for data, like the modes for data.
Well, explain the modes, because I'm not sure everyone knows.
All right, so modes, it's trade, investment, tourism, and migration. I think I got that right.
And consumption abroad.
Yeah. Oh, that's right. So there's the trade is I sit here and sell it abroad. Then investment is like
these are different classifications of services.
Of services, yes.
Yeah.
So American Bank sets up a branch in London and sells services. That's trade and services, but nothing actually crosses a border. Then there's tourism. Like you go and get a medical thing done in Brazil, and then lastly it's migration, more or less. Yeah. But it was all bundled up together. So that's the modes. But the second thing is I think the combination of 5G, privacy laws, and the Internet of Things could lead to a fragmentation of global value chains. And I think an interesting question is where does the virtual and the real interact?
Yeah.
And I think the privacy, when things start to move between machines, including personal data, without human intervention, we may start to have to balkanize the supply chain in order to respect privacy laws.
Right. Christine, you want to talk about measurement quickly, or Susan? Or?
I do. So it's very different. The way we measure services trade right now, we look at gross services trade. It's about 20% of global trade, or U.S. trade, and then goods are 80%. There are a couple things that we're missing. First, we're missing the value added that services provide going into a good, say an automobile that's traded, and that value added is from design, it's from software, it's from intellectual property. We're secondly not capturing a lot of free digital goods trade like the Fortnite playing. And so email, Skype, all these free consumer services that are traded clearly have a value, but the fact that, Google created Gmail and I use Gmail with foreign friends, like that's not captured as a value. And then most importantly, there are important intangible assets that Carol was talking about that are also not captured when they're moved across borders. So Hal Varian, the chief economist at Google, did a calculation saying, look, the Android software that goes into their phones isn't charged when it's sent over to Asia to the manufacturer of the phone. So that's not considered a US service export. If you just counted that, the value of, and when you think about what is the value of a phone, it's not the physical thing, it's the functionality of the phone. We're not capturing that. He said, if we calculated that correctly, that'd be worth $120 billion added to the US trade surplus and services, which is really very significant.
And would wipe 20% off the U.S. trade deficit with the world, right?
Exactly. Yeah. So, or consider like a pair of Nike shoes, say manufactured in Asia, sold in France. Well, Nike has a big markup. You're paying $150, mainly for the swish on the side, whatever. That shows up in France as adding to their GDP as this huge retail markup between the wholesale cost of producing the shoe and then the value of selling it. But none of that is attributed to the creation of the brand value that's allowed that markup. So at any rate, it gets incredibly complex, but it's good that we're measuring services in gross terms, but we're only capturing a small fraction of the services that actually flow across borders. And if we did capture it, it would make the trade balance for some countries, notably the United States, look very different than it does.
And in a world where trade balances drive trade policies and prompt trade wars and so on, the world would be very different. So there you go. So it would all be solved. We'd have peace in our time if we could only measure the proper trade and services. Christine, we're over time, so like 15 seconds.
15 seconds. Just to echo what Susan was saying, and just the continuing need to improve those statistics because there isn't the political will or interest, and that's got to change. And I would add on data, measurement of data as well is really important in terms of driving the policy debate, that we need to change that as well.
Great.
We need to capitalize data as an asset.
Yeah, and this is going to be driving our conversations a lot going forward. Just one quick thing about, Sherry, what you said about Indonesia. You were talking about non-tariff barriers. The most interesting thing I find about Indonesia is they're trying to find a tariff for data. And that is, it's set at 0 now, but them actually creating a tariff on data, that's what terrifies the Googles, the Refinitives, the Bloombergs of the world. Thank you so much. Apologies for going over time. Thanks for bearing with us. If you just put your hands together and thank these very smart people on the stage, it'd be great. Thank you.